Public companies don't decline by accident, they decline by design. And the pattern is so predictable, so mechanical, that once you see it, you can't unsee it. Every product that got worse, every service that started charging more for less, every brand that used to mean something and now means nothing. It's not bad luck, it's not incompetence, it's incentives. And the incentives inside public companies are almost perfectly engineered to destroy the very thing that made them valuable in the first place. If you want to understand why the companies you love always seem to betray you, hit that like button and subscribe, because this one explains everything. To understand the problem, you need to understand what changes the moment a company goes public. Before an IPO, a company is usually run by founders, people who built the thing from nothing. They care about the product because the product is the business. The product is the reason the company exists. The founder's wealth, reputation, and identity are tied directly to whether customers love what they make. But the moment that company lists on a stock exchange, something fundamental shifts. The company now has a new set of owners: institutional investors, hedge funds, pension funds, index funds. These shareholders don't care about your product. They don't use your product. Most of them couldn't even describe what your company does. What they care about is one number: earnings per share, and they want that number to go up. Not eventually, not over 10 years, every single quarter. This is the quarterly earnings trap. Wall Street analysts publish expectations before every earnings report. If a company misses by even a few cents, the stock gets punished. If it beats expectations, the stock goes up. But here's the catch. Once you beat expectations, the bar moves higher. Next quarter, analysts expect more. The quarter after that, even more. The company is now on a treadmill that only accelerates, and the CEO has to keep running. This brings us to the first phase of the decline cycle. Every public company starts in what you'd call the product excellence phase. This is the golden era. The product is great because the product is what got them here. Customers love it. Growth is organic. Word of mouth drives sales. Engineers and designers are the most important people in the building. But public markets don't reward excellence. They reward growth. And eventually, organic growth slows. It always does. No company can grow 20% a year forever by making a better product alone. So the pressure mounts. Investors start asking uncomfortable questions on earnings calls. Revenue growth is slowing. What's the plan? This is when the company enters the optimization phase. The focus shifts from making the product better to extracting more value from the product that already exists. Prices go up. Features get locked behind premium tiers. Free services become paid services. The company starts doing the math differently. Instead of asking, how do we make this better, they ask, how do we make more money from what we already have? This is the phase where streaming services raise prices 6 times in 5 years. The phase where airlines shrink legroom to add another row of seats. The phase where software companies switch from one-time purchases to monthly subscriptions that cost more over 2 years than the product used to cost outright. The product isn't getting better, the margins are, and Wall Street loves it. Analysts call it margin expansion. They praise the discipline. The stock goes up, the CEO gets a bonus, and the customer gets less for more, every single time. But optimization has a ceiling. You can only raise prices so many times before customers notice. You can only cut costs so far before quality slips. So the company enters its third and most dangerous phase, financial engineering. This is where things get truly perverse. S&P 500 companies spent a record $942.5 billion on stock buybacks in 2024 alone. That's not money spent on research. That's not money spent on building better products or hiring better people. That's money spent buying back their own shares to artificially inflate earnings per share. The math is simple. If a company earns $1 billion and has 1 billion shares outstanding, earnings per share is $1. But if that company spends $200 million buying back shares, now there are fewer shares. Earnings per share goes up even if actual earnings didn't. Wall Street celebrates. The stock price rises. Executives get richer. And nothing about the product improved. Boeing is the textbook example. Between 2013 and 2019, Boeing spent $43 billion on stock buybacks. That's more than 100% of its profits during that period. They spent more money buying their own stock than they actually earned. At the height of the buyback frenzy in 2017, 66% of Boeing's total cash spending went to dividends and stock buybacks. Only 9% went to new equipment for actually manufacturing planes. Meanwhile, they outsourced critical manufacturing to cut costs, weakened quality control, and pushed R&D expenses onto suppliers. They sold off their main aerostructures operations in Kansas to a company called Spirit AeroSystems just to trim the balance sheet. The result was 2 fatal 737 MAX crashes that killed 346 people. A door plug blew off a plane mid-flight in January 2024. The company that once defined American engineering excellence had been hollowed out from the inside, not by incompetence, by incentives. Boeing's executives were compensated based on stock performance. In 2014, the company announced that a significant portion of executive long-term incentive pay would be tied directly to shareholder return. Buying back shares was the fastest way to boost that metric, so that's what they did. And then they had to issue $22 billion in new shares just to stay solvent. They literally bought high and sold low with their own stock. Shares that soared 500% between 2013 and early 2019 have since given back most of those gains. That's the financial engineering phase in its purest, most destructive form, and this connects directly to why it keeps happening. CEO compensation at America's 350 largest public companies averaged nearly $23 million in 2024. That's 281 times what a typical worker earns. But here's the number that matters. 79% of that compensation comes from stock-based pay, not salary. Stock options, restricted stock units, performance shares tied to stock price targets. When nearly 80% of your paycheck depends on the stock going up, you don't care about the product. You care about the stock. And the fastest way to move the stock is not to spend 5 years developing a groundbreaking new product. It's to cut costs this quarter, buy back shares this quarter, and beat earnings expectations this quarter. The median CEO tenure at an S&P 500 company has dropped to 4.8 years. Think about that. You have a CEO who knows they'll be in the chair for roughly 5 years, and their compensation is almost entirely tied to stock performance during that window. They have zero incentive to invest in anything that pays off in year 7. Every dollar spent on long-term R&D is a dollar that could have been a buyback. Every investment in quality is a risk to next quarter's margins. This creates a doom loop. CEO arrives, cuts costs, buys back stock, earnings per share goes up, stock rises, CEO cashes out millions in stock options. CEO leaves after 4 or 5 years, new CEO arrives. The easy cuts have already been made, so they cut deeper. More buybacks, more outsourcing, smaller teams doing more work, product gets worse, customer satisfaction drops. But the stock keeps climbing because the financial engineering masks the decay. From the outside, the company looks healthy. Revenue is stable, earnings per share keeps ticking up. But underneath, the foundation is crumbling. The engineers who built the original product are gone. Institutional knowledge walked out the door with them. The new hires are cheaper and less experienced. Quality control is a cost center, not a priority. Then one day, the product failures become too obvious to ignore. A plane crashes. A data breach exposes millions. Customers leave in waves. The stock collapses. And everyone acts surprised. Nobody saw it coming, they say. But the pattern was visible from the start. Wall Street analysts are supposed to be the check on this behavior. In theory, they analyze companies and tell investors when something is wrong. In practice, they reinforce the cycle. Analysts reward companies that hit quarterly targets. They punish companies that invest for the long term. If a CEO announces a massive R&D initiative that will suppress earnings for 3 years, analysts downgrade the stock. Investors sell. The board gets nervous. The CEO gets fired. The replacement is someone who promises to be more shareholder-friendly. More buybacks. More cost cuts. More short-term optimization. The system selects for executives who are willing to sacrifice the future for the present, and it eliminates anyone who tries to do otherwise. There's another layer of protection that keeps this cycle spinning. Oligopoly. In industry after industry, a handful of companies control most of the market. When all the major players are running the same playbook, there's no competitive pressure to stop. Airlines are a perfect example. 4 carriers control over 80% of domestic flights. They all shrink seats. They all add fees. They all reduce service. Because where else are you going to go? The same dynamic plays out in telecom, banking, food manufacturing, and dozens of other sectors. When every company in an industry is publicly traded and facing the same quarterly pressure, they all degrade in lockstep, and the customer has no escape. So what happens at the end? The end game for most public companies follows one of 4 paths. The first is acquisition. A larger company buys the declining brand, strips it for parts, and extracts whatever value remains. The brand name gets slapped on cheaper products. The original identity disappears. The second is stagnation. The company becomes a zombie, generating just enough cash to survive, but never innovating, never growing, slowly fading into irrelevance while executives continue to collect 8-figure paychecks. The third is private equity. A PE firm takes the company private, loads it with debt, cuts costs to the bone, extracts management fees, and either flips it to the next buyer or lets it collapse under the weight of its own leverage. The fourth is the long slide into irrelevance. The company stays public but becomes a shadow of what it once was, still traded, still reporting earnings, but producing nothing anyone cares about. The average lifespan of a company on the S&P 500 has fallen from 33 years in 1964 to under 20 today. Some estimates project it will hit 12 years by 2027. Companies are being created, optimized, extracted, and discarded faster than ever. That's not creative destruction in the healthy sense. That's a system designed to consume its own. Here's the uncomfortable truth. The people running these companies aren't stupid. The CEOs, the CFOs, the board members, they understand exactly what's happening. They know that cutting R&D will hurt in 10 years. They know that buybacks don't create real value. They know that quality erosion drives customers away. But they also know that their stock options vest in 3 years, that their bonus is tied to this year's earnings target, that the board will fire them if the stock underperforms for 2 quarters. The incentives are perfectly rational at the individual level and perfectly destructive at the systemic level. Every person in the chain is doing exactly what the system rewards them for doing, and the result is companies that get worse year after year until there's nothing left. The issue isn't bad people, it's bad structure. And unless the structure changes, the outcome won't either. The quarterly earnings cycle will keep compressing time horizons. Stock-based compensation will keep rewarding financial engineering over product engineering. Share buybacks will keep funneling money to shareholders instead of into innovation. And customers will keep watching the brands they once trusted slowly, predictably, inevitably decay. Public companies don't collapse suddenly, they decay predictably. And now you know why. What do you think? Is there a company you watched go through this exact cycle? Let us know in the comments below. If this breakdown made the pattern click for you, hit that like button and subscribe for more stories of money legends. And if you want to see another billion-dollar decline broken down step by step, you're going to want to watch this next video. Click here to keep watching.